Hello, my name is Tony Lajeunesse, CEO and President of TL Financial Group. Today's webinar is an approximately 30-minute recorded presentation regarding 7 topics to watch out for in 2020 regarding Social Security. Now I have a more in-depth Social Security planning webinar planned for September 15th at 2 p.m. If you're on our email list, you will receive an invitation to that presentation. It'll be emailed to you. And then also you can also visit our website where the invitation will be there. And if you are on Facebook, you can follow us on Facebook and you'll see the invitation there as well. So with that said, let's go ahead and get started with today's presentation. Let me go ahead and get this started. Okay, so what's new with Social Security for 2020? 7 topics that you should be aware of. Here are the lists of all the topics that we're going to be touching on. Social Security paid a small cost of living adjustment this year. We'll talk about how the COLA is determined, the cost of living adjustment, and we'll put it in its context and see what it means for Social Security benefits going forward. Another number affected by the cost of living adjustment is the earnings test threshold. We'll talk about how you can, what you can earn in 2020 without having benefits withheld if you claim Social Security before full retirement age. And then next, we'll talk about taxes, both the Social Security payroll taxes and the income taxes you may have to pay on your Social Security benefits. And then for those of you who are on Medicare, we'll go over the new Part B premiums for 2020 and see why it's not such a straightforward number anymore. We'll also cover dates to watch for in 2020. We're going to give you an update on the status of the Social Security Trust Fund and discuss some ideas for reforming the system to make it solvent for the future. And then finally, we'll give you an update on Social Security claiming strategies. Let's first start with the cost of living adjustment. In October, every year, the Social Security Administration announces a bunch of numbers that are determined by the rate of inflation over the prior 12 months. So the most eagerly awaited number is the cost of living adjustment, or the amount by which Social Security checks are going to be raised. Another number is the new earnings test threshold. And then finally, the maximum amount of earnings on Social Security taxes are assessed. Now, the cost of living adjustment for 2020 was 1.6%. So this means if your current benefit is $800, you're going to get an extra $12.80 a month. And you can see this scale on your screen here. The higher your benefit is, the higher your cost of living adjustment is. If your benefit is $3,300, which could happen if you're a maximum earner and you claimed your benefit at age 70, you would be getting a cost of living adjustment of over $52 per month. But here's the kicker. If you enrolled in Medicare and having your Medicare premium taken out of your Social Security check, you may not see this much of an increase. Part of your COLA may be absorbed by the Medicare premiums. And we'll talk about Medicare premiums in just a few minutes. So to put this year's cost of living adjustment in perspective, you can see here what the annual COLA has been since 1985. Inflation has been low over the past few years, so COLA has been low. Going back to 1985, the cost of living adjustment has averaged about 2.6% per year, and the Social Security trustees actually project a 2.6% COLA going forward. Now, the COLA is based on the Consumer Price Index for all urban wage earners. The Consumer Price Index measures the change in a basket of goods and services that a typical urban worker might buy. It covers food, transportation, housing, entertainment, healthcare, and pretty much everything people spend their money on. In any case, the COLA is announced each year in October and takes effect with Social Security checks that you're going to receive in January. So even if you haven't started your Social Security yet, let's say you're delaying it to age 70 to get that higher amount, your benefit will be raised by the COLA. So when you do claim your benefit, you can be sure it will reflect each year's cost of living adjustment. So if you're interested in learning how the COLA was calculated, you can visit this website shown here at the bottom of the screen. And that will give you a really good detail to show you how it's calculated. Okay, so that's the first big number change. Next, we're going to be discussing the earnings test. Now, the earnings test threshold is affected by the cost of living adjustment. So as you probably know, if you are under full retirement age and you work and receive Social Security benefits, okay, part of your benefit may be withheld. They withhold $1 for every 2 you earn over the threshold, which went up to $18,240 this year compared to $17,640 last year. So if you earn less than the $18,240, none of your Social Security benefits will be withheld. But I would just like to comment that trying to earn less money is not exactly a formula for wealth building either. So if you're under the full retirement age and have the opportunity and ability to work, it's probably better to earn as much as you can and delay applying for Social Security. Now, of course, everybody's situation is different, and it really does require individual planning. So if you need a Social Security analysis to see what is optimal for you, please contact our office and we'll provide one for you. Now, the new threshold for the year you turn full retirement age is actually $48,600, up from $46,920 last year. This higher threshold comes into play if you were receiving Social Security last year and you turn full retirement age in 2020. In the months leading up to your full retirement or full retirement age month, $1 in benefits will be withheld for every $3 you earn over $48,600. So once you turn full retirement age, no benefits will be withheld no matter how much you earn. So that's a good thing. Now, while we're on the earnings test, I'd like to take a moment and explain the monthly earnings test. This comes into play the first year you apply for Social Security benefits. So let's say you are under full retirement age, you file for Social Security this year, and you continue to work. If you earn more than $1,520 in any month, your benefit will be withheld. Then next year, you will be subject to the regular annual earnings test, $18,240 adjusted for next year's cost of living adjustment. So generally, our recommendation is to wait until you stop working to apply for Social Security so you don't have to deal with that earnings test. But there may be some exceptions, and we can certainly discuss your individual circumstances, of course, as it pertains to you. Okay, having said all that about COLA and the earnings test, I now want to take a moment to discuss payroll taxes. How does this work? The maximum earnings subject to Social Security tax went up from $137,700 from $132,900 last year. This means higher earners will pay Social Security taxes of more on their earnings. But remember that Social Security taxes represent a pretty good investment in the form of inflation-adjusted income that lasts for life. The more earnings you have and the more Social Security taxes you pay, the higher your benefit will be. And remember, as long as you are working and paying into Social Security, your benefit will continue to be adjusted. If you improve your earnings record, your benefit may go up, and even if you already started collecting your benefit already. So if you're interested in seeing how the Social Security Administration calculates the earning cap, you can follow this link that you see here at the bottom of your screen. Now, the Social Security tax rate didn't change. As an employee, you're still going to pay the 6.2% in payroll taxes on your earnings. Your employer will pay the same amount. If you are self-employed, you will pay both parts for a total of 12.4%. The Medicare tax also didn't change. The employee's portion is 1.45 on all earnings. Self-employed people pay both sides or 2.9%. Here's the math. If you earn the maximum $137,700 in 2020, you will pay about $8,537 in Social Security taxes. If you're self-employed, you're going to pay both the employees and the employer's share of the tax, or $17,075. The Medicare tax will be on top of that. Now that takes care of the payroll taxes, or the taxes collected to fund Social Security and Medicare. Now we're going to discuss and talk about taxes on your actual benefits, which are a little bit different. Ever since 1984, Social Security benefits have been subject to some level of taxation depending on your other income. This table that you're looking at shows the taxation of Social Security benefits based on the various income levels. Income, in this case, means provisional income, which includes adjusted gross income plus 1/2 of your Social Security benefit plus any tax-exempt interest. If provisional income is under $32,000 for a married couple, no benefits are subject to the tax. If provisional income is between $32,000 and $44,000, up to 50% of a married couple's benefits are subject to a tax. If provisional income is over $44,000, up to 85% of your benefits are subject to tax. Now, you're not taxed at 85% tax rate, you're taxed at your ordinary income tax rate. So the thresholds for a single individual are $25,000 and $34,000. In the case of a married filing separately and living with the spouse, 85% of Social Security is taxable regardless of the income level. Note that these income thresholds were never adjusted for inflation, so more and more people are having to pay income taxes on their Social Security benefits. The important thing to remember here is that up to 85% of your Social Security benefits may be subject to tax depending on how much other income you have. Now, you may have had your income and tax situation all figured out, and then you have to start taking required minimum distributions from your IRA. If you don't plan ahead, these RMDs can bump you into higher income tax brackets. In addition to having to pay income tax on the RMDs, they might cause you to pay more tax on your Social Security benefits, so it's really important to understand this. The law recently changed with regards to RMDs. The minimum age was raised to 72 from 70 and a half. If you'll be turning 70 and a half after December 31st, 2019, you'll be under the new rule and you can start your RMDs at age 72. If you're already 70 and a half at the end of 2019, you'll still be under the old rules and have probably already taken your RMD for 2019, unless 2019 was your first year for RMDs and you decided to defer it until April of 2020. With all of that said, you can defer your 2020 RMDs due to the CARES Act. So please let me know if you need help figuring out your RMDs. It's a good idea to plan for Social Security taxes ahead of time. Those of you who are still well in advance of that 72nd birthday, you might want to consider drawing down those assets so the RMDs don't force you into a higher tax bracket for Social Security. The operative word here is might, because beating the Social Security tax might not be worth it as well, pending other tax considerations. So make sure you consult with us or another qualified tax professional. You may also want to convert to a Roth IRA, which generates tax-free income. Again, please consult a tax specialist before doing that. The other way to pay less in Social Security is to delay it, reducing the number of years your income is subject to tax. So this is not the main reason to delay benefits. Delaying Social Security benefits is mostly advantageous because of the higher benefit that you're going to get by delaying, but it also helps with the tax situation as well. We recommend running a tax analysis before these decisions are made, and we can help you with that. You want to make sure you're making the right choice with your eyes wide open. Now, the big legislative news at the end of 2019 was the passage of the Secure Act. This sweeping legislation has lots of provisions, but the ones most likely to affect the people here are these. Number one, RMDs can now be taken starting at 72 instead of 70 and a half, which we just talked about. Number two, if you are over 70 and a half and you have earned income, you can now contribute to an IRA. It used to be that you couldn't contribute to an IRA after age 70 and a half, but now people are living and working longer, and IRA contributions are allowed after that age, but it has to be earned income. This opens up some interesting strategies that we can talk about privately if you're interested. And then of course, number three, inherited IRAs. This is a big one. They must now be drained by the end of the 10th year. It used to be that the IRA beneficiaries could stretch the RMDs over their lifetimes in order to keep deferring taxes. But the government says no more, except in the case of spouses and a few other exceptions. IRA beneficiaries must take and pay taxes on the entire IRA by the end of the 10th year. If you have more questions about that, please consult with me, because there are a lot of moving parts to that as well. And we should mention the Tax Cuts and Jobs Act of 2017, which took effect in 2018. Even though it's been around for 2 years, people are still getting used to the new tax rates and the standard deductions. So you may need to continue to fine tune your withholding or estimated taxes for 2020. And as always, talk to tax advisors about strategies that you can implement before 2020 is over to help save on your taxes. All right, let's move on to Medicare premiums. The base Part B premium is now $144.60 per month. Some people will pay more due to the income-related monthly adjustment amount, or what's called the IRMAA. If you are on Social Security and have your Medicare Part B premium deducted from your Social Security benefit, which many of you probably do, there is a hold harmless provision that keeps your check from going down if the Social Security cost of living adjustment doesn't cover the rise in the Part B premium. So for example, in 2017, the premium jumped from $121.80 to $134. That's a 10% increase. But the Social Security cost of living adjustment was only 0.3%. So the few dollars that people got for their COLA didn't cover the premium increase. So their premium was left at $121.80 plus whatever their COLA amount was. Some people's premium was even lower than that because they had been held harmless in prior years. So this year, the Social Security COLA was 1.6%, while the Part B premium went up by $9.10. So this means that for most people, the COLA more than covered the increase in premiums. A few people who got very low COLAs because their benefits are very low may pay less than the full $144.60 in premium. Now, the issue that will be affecting more people is the income-related monthly adjustment amount, or the IRMAA. That's going to be applied to their Medicare premiums. The IRMAA is an extra premium you must pay if your modified adjusted gross income exceeds certain thresholds. So starting this year, the thresholds are adjusted for inflation. The first threshold is $87,000 if you're single or married filing separately, up from $85,000 last year. For married couples, the first threshold is $174,000, up from $170,000. Your modified adjusted gross income for this purpose is adjusted gross income plus tax-exempt interest. Your premium each year is based on the tax return you file 2 years prior. So if you're on Medicare, your 2020 premium is based on your income you reported in 2018. But if your income has changed due to a specific life-changing event, such as retirement, you can appeal. In other words, if you reported high income in 2018 and you have since retired, you can appeal the higher premium. Please note that a one-time capital gain is not grounds for an appeal. In other words, if your 2018 tax return shows high income because you sold an asset in that year, you'll have to pay the higher premium in 2020. But if your income has gone back down in 2019, your 2021 premium will be lower. As mentioned, the income thresholds are now being adjusted for inflation. As you can see here, this table shows the Part B and Part D premiums for the different income levels. So if you're single and your income is under $87,000, or if you're married and your income is under $174,000, you're going to pay the regular Part B premium of $144.60 per month. There will be no income-related adjustment. Your Part D premium will vary, but if you pick a plan that charges the average premium, you'll pay about $40 per month for a total of $184.60 per month for Part B and D coverage. If your income falls into one of these other tiers, you'll pay an income-related adjustment on top of the base premium. So for example, if you're in the second tier, you'll pay an extra $57.80 for Part B, and of course $12.20 for Part D on top of your regular premiums. This will bring your total up to $254.60 per month. So keep in mind that these are per person. So if you're a couple, you obviously double these amounts. Your tax return from 2 years ago is used to determine this income-related adjustment. For example, the adjustment for 2020 would be based on the income reported on your 2018 tax return. So if you plan on taking extra money out of your IRA and you're on Medicare, then we really need to take this into consideration, because you could really bump yourself up into the next bracket. Again, a tax analysis really should be completed so that you don't unnecessarily pay higher taxes. And keep in mind that the premiums shown here do not include premiums for Medicare Advantage or Medicare supplemental plans. This is just your Part B and Part D only. So it can get pretty expensive. So whether you're already on Medicare or getting ready to start, there are some dates that you're going to need to pay attention to. The Medicare Advantage disenrollment period is from January 1st to March 31st. During this time, you can get out of a Medicare Advantage plan and go back to the original Medicare, but do make sure you can get supplemental coverage. If you're going back to original Medicare, you're going to want the gaps covered with a Medigap policy. But unless you are applying during your Medigap open enrollment period, which is generally the first 6 months after enrolling in Part B, they don't have to take you. So if you have health issues and you drop your Medicare Advantage plan, you may not be able to get a Medigap policy. So make sure to get that lined up first if you're thinking about dropping your Medicare Advantage plan. Super important. January 1st through March 31st is also the Medicare general enrollment period. This is for people who never signed up for Medicare when they turned 65 or left their employer plan. If you do sign up for Medicare during this time, your coverage is going to start on July 1st. Now, the annual open enrollment period for people on Medicare is October 15th to December 7th. In September, you're going to receive information from your current plan about their offerings for the next year. So make sure you pay attention to that. Your premiums might be going up, or your coverage might change a little bit, or there might be new plans in your area. If you currently have a Medicare Advantage plan, you'll want to see how it will change for next year. If you have original Medicare, you'll want to see how your drug plan will change for next year. Then you'll want to take a look at the other plans offered in your area and see if any of them might be better. If so, contact the new plan by December 7th. If you do nothing, you will be re-enrolled in your current plan for another year, although you will have another chance to switch Medicare Advantage plans during the disenrollment period that we just talked about. It's much more efficient to make your choice during this annual open enrollment period and stay in your new plan for the full calendar year. I will actually be hosting an in-depth Medicare webinar on October 13th, so mark that on your calendar if you're interested in that. Also keep an eye out for an email, or you can visit our Facebook page or our website to register for that. So again, we'll do an in-depth Medicare course on that date. All right, what about the future of Social Security? Everyone's always interested in this, and for good reason. Social Security was designed as a pay-as-you-go system. Payroll taxes from current workers go into a trust fund, and then they're immediately paid out to current retirees. Because baby boomers have been in their peak earning years, the trust fund has actually accumulated more than what's needed for the current benefits. Right now, the trust fund holds about $2.9 trillion, which is invested in special issue treasury securities. As baby boomers start retiring, these trust fund assets will gradually be drawn down. Over the next 75 years, costs will begin to exceed income. There are enough reserves that the system will be able to pay 100% of promised benefits until 2034. After that, if nothing is done to reform the system, income is only going to be sufficient to cover just about 79% of the promised benefits. Although the Social Security system is not in imminent danger, most people agree that the earlier reforms are instituted, the less painful they're going to be on everybody. So it's really just a math problem that involves an increase in revenues, a cut in benefits, or a combination of the two. Here are just a few of the ideas that have been proposed. One is to increase the maximum earnings subject to Social Security tax. Currently, it's $137,700. That's subject to the 6.2% tax paid by you and your employer. One way to shore up the system is to raise the earnings cap or eliminate it altogether. Another reform proposal calls for raising the normal retirement age. Currently, full retirement age is 66 for people born between 1943 and 54, and then it's 67 for people who were born in 1960 or later. An argument in favor of raising the retirement age is that people are living longer. An argument against it is that people whose occupations involve harder physical labor really can't work until age 70. Still, another reform proposal would change the benefit formula so that future increases would happen at a slower pace. This would affect the benefits of future retirees. And some are talking about changing the formula for cost of living adjustments. This could give retirees smaller benefit increases going forward, although the changes are expected to be minimal. Now, given that there are lots of ways the Social Security system can be reformed, is Congress likely to address the issue this year? Some say now that the Democrats have a majority in the House, they may get around to acting on a previous proposal introduced by Representative John Larson. This proposal would make several changes to the system, both raising benefits and raising taxes. Benefits or current retirees would not be affected, except that the cost of living adjustments would be based on a new index that measures inflation for the elderly. That is, it would take into account things that retirees tend to spend their money on, like healthcare, so it would presumably be an improvement. If passed, this proposal would restore full solvency to the system over the next 75 years. Other people say that Congress will probably not address Social Security this year. Republicans and Democrats can't seem to agree on much, and because of that, the $2.9 trillion trust fund, those benefits are not in immediate danger. So the last time Congress made major changes to the Social Security system, that was in 1983, and the trust fund was within just a few months of running out of money. So theoretically, Congress has until 2035 before they have to worry about that happening. We'll see what happens. All right, to finish up, I'd like to talk a little bit about Social Security claiming strategies, even though these may not affect all of you, especially those of you who have already started taking your Social Security benefits. Some of you on this webinar may have heard about a strategy called File and Suspend. To refresh your memory on this, that's the one where a high-earning spouse files for his benefits, immediately suspends them, and because he's opened his record, the lower earning spouse can claim a spousal benefit. So the Budget Act passed in November of 2015 disallowed certain spousal claiming strategies. File and suspend was one of them. The last day to file and suspend was actually April 29th of 2016. Unless you placed your suspension before April 29th, 2016, your spouse will not be able to claim a spousal benefit this way. For those of you who did suspend before the deadline, and honestly, that's the only reason I bring this up, it is mostly a question of making sure your spouse takes their spousal benefit at the optimal time, if they haven't already. Other than that, it's basically a question of sitting back and waiting. Your benefit will automatically resume at age 70. The other strategy, claim now, claim more later, is more important. So if you were born before January 2nd, 1954, you're grandfathered for a key strategy which could potentially shore up your retirement. Now remember, it is not generally possible to take a benefit based on your spouse's record if your own benefit is higher. But those of you born before January 2nd of 1954 can do just that, provided you wait until your full retirement age and directly specify on your application that you want your spousal benefit only. Why would you do this? If you restrict your application to your spousal benefit only, you can receive a spousal benefit, while your own benefit builds those delayed credits. So let's take a look at an example. John and Jane are both 66. John's primary insurance amount, or his PIA, is $2,400. Jane's is $1,600. So here's what they can do to increase their Social Security benefits. Jane files for her benefit now and starts receiving $1,600 a month. John files on Jane's record and receives half of her benefit, or $800 a month, while his own benefit builds delayed credits. When John turns 70, his benefit will have increased to $3,168 thanks to 4 years of an 8% annual delayed credits. That's pretty impressive. So he gets half of Jane's benefit for 4 years, then switches to his own maximum benefit. If John dies, his higher benefit will transfer over to Jane. This is basically the best case scenario for this couple, but there's no guarantee that it'll be this neat and tidy for you. It really does depend on your respective age. So please see me about whether or not this is something that you would like to talk about in your specific case. Okay, that takes care of what's new with Social Security. Again, I'm going to be hosting a more in-depth Social Security planning webinar on September the 15th at 2 p.m. And here are some of the examples that we're going to be covering in that next webinar. Here's a situation that's not terribly uncommon. We see it often. A married person who never added on her spousal benefit after her husband filed. So for example, in doing Social Security checkups, we would look to see if the lower earning spouse's benefit is significantly lower than 50% of the higher earning spouse's benefit. This could suggest that the lower earning spouse filed first and then claimed her own small benefit. Then sometime later, her husband filed for his benefit. This would entitle her to a spousal benefit, which would be added to her own small benefit. But she would have to apply for a spousal benefit, which she didn't know to do. Our Social Security checkups reveal things like this. And we'll talk more in detail at that next webinar. Another big thing is this, is a divorced person who didn't know she could claim a spousal benefit off of her ex-spouse. Now, not everyone can do this. It is being phased out by the Budget Act, but some people can still do it. And some people have more than one ex-spouse. They may be claiming off of the wrong ex-spouse. Our Social Security checkups can help divorced people find out if they're receiving all the benefits that they are entitled to. And here's another one. A divorced person whose ex-spouse has died. You know, sometimes the ex-spouses don't always keep track of each other, but if a person was married over 10 years to an ex-spouse who has died, she may be able to get a survivor benefit based on that ex-spouse's earnings record, which is higher than her own benefit. And these are not limited to women. Social Security is gender neutral. Divorced men can also claim benefits on an ex-spouse's work record. So if you or anyone you know would like a Social Security checkup, we may be able to help identify these possible benefits and explore claiming strategies and see how Social Security fits into the rest of your overall retirement income plan. You can call or email me to set up that appointment. Okay, this concludes our Social Security update presentation. Again, I'm going to be hosting an in-depth Social Security planning webinar on September 15th at 2 p.m. If you are on our email list, you're going to receive a registration email soon, or you may visit our website to register as well. Thanks for your time today. Be safe and healthy, and I'll talk to you soon.